Harmony Gold has recently executed a pivot that is reshaping its investment profile, from a geographically concentrated South African gold miner into a diversified international producer of gold and copper. As the largest gold producer in South Africa by volume, the company maintains a complex portfolio of deep-level underground mines, surface reclamation operations, and international assets in Papua New Guinea and Australia. The investment thesis for the company's American Depositary Receipts, ADR, which trade on the New York Stock Exchange under the ticker HMY, is currently defined by a value over volume strategy. This approach prioritizes higher margin production and operational discipline over simple output growth. This analysis examines the company's operational mechanics, financial performance, and intrinsic value through an expanded valuation framework, focusing on earnings multiples and net asset value, NAV, while assessing the implications of its recent entry into the Australian copper market and the evolving regulatory landscape in South Africa. Operational architecture and jurisdictional footprint. The operational core of Harmony Gold is rooted in the South African Witwatersrand Basin, a region renowned for its high-grade but technically demanding gold deposits. The company's portfolio is structured to balance the high-risk, high-reward nature of deep-level mining with lower-risk, stable-margin surface operations.
In South Africa, the company operates several major underground mines, which are categorized based on their grade and remaining life of mine. The flagship high-grade operations include Mponeng and Moab Khotsong, both of which are central to the company's current cash flow generation and long-term reserve base. Mponeng is one of the deepest mines in the world, delivered a phenomenal performance in the 2025 financial year, with underground recovered grades reaching 11.27 grams per ton. This grade performance is not merely an operational highlight, but a critical financial buffer that allows the mine to remain highly profitable despite the significant costs associated with cooling, ventilation, and seismic management at extreme depths. The Moab Khotsong operation serves as another primary pillar of the South African portfolio. While it remains a high-grade asset, it is currently in a transitional phase as the company mines out the middle mine and transitions toward the Zaya Place project. This transition resulted in a planned 20% year-on-year decline in production at Moab Khotsong during the first quarter of the 2026 financial year. However, the long-term outlook for these high-grade assets is supported by major life-of-mine extension projects. Management intends to extend the productive life of both Mponeng and Moab Khotsong to approximately 20 years each, with expected steady-state production between 200,000 and 250,000 ounces annually per asset once these projects are complete.
These extensions are vital for the company's valuation, as they provide a long-dated production baseline in a high-grade environment, which significantly enhances the net asset value of the South African segment. Complementing the underground mines are the South African optimized operations, which focus on maximizing free cash flow from mature ore bodies. These include Doornkop, Kusasalethu, Chepong North, Chepong South, Joel, Target 1, and Masimong. While these mines generally operate at lower grades than Mponeng, they record consistent delivery. Furthermore, the company's surface operations, particularly those involved in tailings retreatment, represent a quiet powerhouse of low-risk cash flow. Despite challenges such as heavy rainfall, which reduced surface production by 13% in fiscal 2025, these operations maintained solid margins of approximately 36%. Internationally, the Hidden Valley mine in Papua New Guinea has demonstrated resilience and profitability. In the first quarter of the 2026 financial year, Hidden Valley generated 1.7 billion South African rand in adjusted free cash flow, doubling its performance from the prior year as recovered grades increased by 31% to 1.63 grams per ton.
The Papua New Guinea portfolio is also anchored by the Wafi-Golpu project, a Tier 1 copper-gold asset. While still in the permitting stage, Wafi-Golpu is considered a transformational growth project that will eventually provide Harmony with long-life, low-cost production in a Tier 1 commodity. The geographic diversification into Papua New Guinea and now Australia is a strategic imperative designed to reduce the organization's jurisdictional risk profile while providing exposure to metals essential for the global energy transition. Strategic expansion, the Australian copper pivot. The acquisition of MAC Copper and its CSA mine in Australia has diversified Harmony Gold. Completed on October 24, 2025, the transaction gives Harmony 100% ownership of a high-grade, producing copper asset in a stable mining jurisdiction. The CSA mine is expected to contribute immediate copper production and cash flow, with an estimated annual output of over 40,000 tons. This acquisition was funded through a combination of existing cash reserves and a $1.25 billion bridge facility, which the company intends to replace with longer-term funding sources.
The entry into Australia is further bolstered by the EVA Copper project, which has been approved for development as a high-margin, long-life asset. EVA Copper is projected to produce between 55,000 and 60,000 tons of copper annually, with first production expected in 2028. From an investment perspective, this shift into copper addresses several structural challenges. First, it provides a natural hedge against gold price volatility. Second, it diversifies the company's revenue stream away from the deep-level mining constraints of South Africa. The company now holds 1.93 million tons of contained copper in mineral resources at EVA Copper alone, representing a 31% increase following updated feasibility studies. This copper strategy is not merely an add-on to the existing gold business, but is centrally embedded in the Mining with Purpose framework. By acquiring producing assets like CSA and developing projects like EVA and Wafi-Golpu, Harmony is effectively leveraging its gold-generated cash flows to build a multi-commodity portfolio with a lower average cost of production.
Financial performance and three-year trend analysis. The financial trajectory of Harmony Gold over the preceding 3 fiscal years reveals a period of aggressive deleveraging and margin expansion. Group revenue grew from 49.3 billion South African rand in the 2023 financial year to 73.9 billion rand in 2025, representing a 50% increase in just 2 years. This growth was predominantly driven by a 27% increase in the average gold price received, which reached 1,529,358 rand per kilogram in 2025, up from 1,201,653 rand per kilogram in 2024 and 1,032,646 rand per kilogram in 2023. The company's ability to capture this price upside while maintaining consistent production volumes has been the primary engine of its record free cash flows. Operational profitability has seen a commensurate rise. Headline earnings per share, HEPS, increased by 26% in fiscal 2025 to 2,337 South African cents, compared to 1,852 cents in 2024. Basic earnings per share saw an even more dramatic 67% increase to 2,313 cents in 2025. This earnings growth was achieved despite a 17% increase in the group's all-in sustaining costs, AISC, which rose to 1,054,346 rand per kilogram, approximately $1,806 per ounce in 2025. The rise in AISC was primarily attributed to inflationary pressures on labor and electricity, as well as increased sustaining capital expenditure for the life-of-mine extension projects at the high-grade mines. Notably, royalties increased to 41,000 rand per kilogram in 2025, reflecting the company's improved profitability and revenue.
The company's balance sheet has transitioned into a position of considerable strength. At the end of the 2023 financial year, the company reported a net debt position of 2.8 billion rand. By the end of 2025, this had swung to a net cash position of 11.1 billion rand, an improvement of 285% year-on-year. This liquidity reached 20.9 billion rand in cash and undrawn facilities at the end of fiscal 2025, and further expanded to 26.6 billion rand by the end of the first quarter of fiscal 2026. This financial flexibility is critical for the organization as it ramps up capital expenditure for its copper growth projects and continues to fund dividends. The net debt to EBITDA ratio remained below 1.0x even after the completion of the MAC Copper acquisition, underscoring a disciplined approach to capital management. Cash flow generation has reached record levels, with adjusted free cash flow increasing by 54% in fiscal 2025 to 11.1 billion rand. This resulted in an adjusted free cash flow margin of 16% for the year. The high-grade underground operations contributed 53% of the group's operating free cash flow, with Mponeng alone accounting for 39% in earlier reporting periods. These robust cash flows support a predictable dividend policy, where the board approved a record final dividend of 155 SA cents per share for fiscal 2025, bringing the total payout for the year to 2.4 billion rand.
Valuation analysis, market multiples. The valuation of Harmony Gold, HMY, requires a nuanced understanding of both its current market positioning and its forward-looking growth potential. Historically, the company has traded at a discount to its global peers, a phenomenon often attributed to the technical risks of deep-level mining and the jurisdictional risks associated with South Africa. However, current valuation metrics suggest that this discount may be narrowing as the company's strategic shift takes hold. Price-to-earnings multiples. As of late 2025 and early 2026, the company's trailing 12-month P/E ratio was reported in the range of 13.91 to 15.49/21. This TTM ratio is considered normal compared to historical levels, but significantly lower than the broader metals and mining industry average, which frequently sits above 20.0. A more compelling indicator is the forward P/E ratio, which incorporates the market's consensus expectations for future earnings. Estimates for Harmony's forward P/E sit at approximately 6.62 to 6.97. This forward multiple represents a 57.3% discount to the industry average of 16.33, suggesting that the market has not yet fully priced in the earnings growth expected from the higher recovered grades and the new copper contributions.
The price-to-earnings growth ratio further supports the case for undervaluation, with a PEG ratio reported between 0.21 and 0.45. The stock is trading at a discount relative to its expected earnings growth rate. In financial theory, a PEG ratio below 1.0 indicates that a stock is potentially undervalued, and Harmony's exceptionally low ratio reflects a growth at a sensible price opportunity. Analysts expect earnings per share, EPS, to grow at a normal yearly rate of 25.45% in the coming years, driven by the structural improvements in the portfolio and the expansion into copper. Enterprise value to EBITDA. The enterprise value to earnings before interest, taxes, depreciation, and amortization, EV/EBITDA, multiple is perhaps the most critical valuation tool for mining companies, as it accounts for the company's net debt or cash position. Harmony's current EV/EBITDA ratio is approximately 7.5 to 7.9. While this has increased from a historical low of 3.4 in 2021, it remains well below its 10-year median of 5.81 and far below the peak of 36.2 seen in 2020 during a period of operational disruption. Comparing this to peers reveals a persistent relative discount. Gold Fields recently reported an EV to EBITDA multiple of approximately 12.1, while Sibanye-Stillwater stood at 12.5 and AngloGold Ashanti at levels often exceeding 10.0. This valuation gap is partly explained by Harmony's higher AISC. However, as the organization transitions into lower-cost copper production and extends the lives of its high-grade gold mines, there is an argument for multiple expansion. The company's EV to EBITDA is currently ranked better than 70% of 628 companies in the metals and mining industry, indicating a superior valuation profile relative to many global competitors. Other market ratios. Other key ratios provide a holistic view of the company's valuation and financial health. The price-to-free cash flow ratio is approximately 19.74, while the price-to-operating cash flow, P/OCF, ratio is 9.56. The price-to-sales, P/S, ratio stands at 2.7 to 2.88, reflecting the company's increased revenue base. From a solvency perspective, the company's Altman Z-score is a robust 7.86, indicating a very small probability of financial trouble and outperforming 74% of the industry. Furthermore, the debt-to-equity ratio is exceptionally low at 0.04, reflecting the company's shift toward a net cash position.
Valuation analysis. Net asset value, NAV. A net asset value, NAV, analysis provides an intrinsic valuation based on the fundamental worth of the company's mineral assets. Harmony's total attributable gold and gold equivalent mineral reserves were 36.8 million ounces as of June 30, 2025, down from 40.3 million ounces in 2024. This reduction was primarily due to depletion from mining, 1.7 million ounces, and the exclusion of certain gold equivalents following updated technical assessments. However, the company's total mineral resources remain globally significant at 135.5 million ounces. Asset level value contribution. The NAV of the South African underground operations is heavily concentrated in Mponeng and Moab Khotsong.
These assets are valued not just on current production, but on their terminal value following the life of mine extension projects. By extending the mine life to 20 years, Harmony has effectively added millions of high-grade ounces to its long-term production profile, which significantly boosts the discounted cash flow (DCF) valuation of these assets. In contrast, the optimized underground operations are valued as cash cows with shorter remaining lives, focusing on maximizing immediate returns rather than long-term growth. The surface operations provide a low-risk component to the group NAV. These operations involve retreating historic tailings, a process with much lower capital intensity and operational risk than underground mining. The ability of these assets to maintain high margins, 36%, even under adverse weather conditions, makes them a highly stable part of the valuation. The international portfolio, specifically Hidden Valley, has seen its value contribution rise following the grade increases in the Big Red part of the ore body. The NAV also includes a substantial value for the Wafi-Golpu and Eva copper projects, which represent the next generation of the company's growth. Price/NAV comparison. As of late 2025, Harmony Gold was trading at a price-to-NAV ratio of approximately 4.28. This ratio reflects the market value of the issued shares relative to the company's net asset value per share of 7,598.84 South African cents. A price-to-NAV above 1.0 is common for major gold producers with significant reserves and exploration potential, as it indicates the market is pricing in the future conversion of mineral resources into mineral reserves and the potential for new discoveries. Compared to peers, Harmony's price-to-NAV is in line with or slightly below the industry average for companies with similar resource bases, suggesting that the company is fairly valued, but has upside if it successfully executes its copper projects.
The price-to-book (PB) ratio, a related metric, is reported between 3.95 and 4.4926. While this is considered high compared to the broader material sector average of 1.6, it reflects the premium assigned to precious metals reserves during a commodity upswing. The company's return on equity (ROE) of 22.97 to 29.99% and return on invested capital (ROIC) of 20.62% further justify this premium, as they indicate a highly effective operator that is skilled at creating profits from the capital reinvested into the business. Regulatory dynamics and operational risks. The investment case for Harmony Gold is inseparable from the regulatory and structural environment in South Africa. The mining sector in the country is currently navigating a period of rapid regulatory evolution, with several key pieces of legislation set to impact operational costs and compliance requirements. Energy and utility constraints. The reliance on Eskom, the state-owned electricity utility, remains a primary risk factor. Underground mining is energy-intensive, requiring constant power for hoisting, cooling, and ventilation. NYSE recently approved an Eskom tariff increase of 12.74% effective April 1, 2025, which adds immediate inflationary pressure to the company's rand-based cost structure. While the company has managed to avoid major production losses from load shedding through proactive engineering and the use of alternative power sources, the rising cost of electricity is a persistent challenge for the South African operations. To counter this, the organization has embarked on a renewable energy strategy. This includes the development of a 100-megawatt solar project at Moab Kotsong and the exploration of other renewable energy options to reduce dependency on Eskom. This transition not only mitigates cost risks, but also shields the organization from the volatility of fossil fuel prices. Additionally, water management is a critical operational focus, with a new 10 megaliter per day reverse osmosis water treatment plant commissioned at Tautona in July 2025 to enhance water recycling and sustainability. Taxation and carbon policies. The fiscal environment is also shifting. The South African government's carbon tax framework is moving into Phase 2 in 2026, which will see a reduction in the tax-free carbon allowance from 60% to 30%. This policy change is intended to incentivize decarbonization, but will inevitably raise the tax liabilities for carbon-intensive industries like mining. Harmony is targeting a 25% reduction in operational carbon emissions across its Papua New Guinea and South African operations by 2026 to mitigate this impact.
Additionally, the South African Revenue Service, SARS, has identified mining as a high-risk sector for audits, targeting royalties, diesel rebates, and transfer pricing, which requires a renewed emphasis on audit readiness and documentation. The local dividend withholding tax rate of 20% is another relevant factor for shareholders. For the 155 SA cents final dividend declared for fiscal 2025, the net local dividend for liable shareholders is 124 SA cents. Non-resident shareholders, including those holding ADRs in the United States, may be subject to different rates depending on double taxation agreements, DTA, between South Africa and their country of residence. Peer comparison and industry positioning. In the global gold mining sector, Harmony Gold occupies a unique position as a deep-level specialist with a growing base metal footprint. A comparison with other major producers like AngloGold Ashanti and Gold Fields illustrates the strategic differences that define the sector. Scale and production comparison. AngloGold Ashanti produced 2.47 million ounces of gold in 2025, representing a 21.5% increase from the prior year and maintaining its position as one of the world's largest producers. In contrast, Harmony's production of 1.48 million ounces in fiscal 2025 makes it the largest producer in South Africa and the 12th largest globally. While AngloGold and Gold Fields have sought to diversify away from South African underground assets, Harmony has focused on extracting maximum value from these mature ore bodies while using the generated cash to expand into copper.
Cost structure comparison. The cost profiles of these companies vary significantly. AngloGold Ashanti reported an AISC of approximately $1,580 to $1,705 per ounce for 2025. Gold Fields maintains even lower costs at some of its mechanized Australian assets. For instance, Granny Smith had a 2024 AISC of $1,173 per ounce. Harmony's group AISC of $1,806 per ounce in fiscal 2025 is toward the higher end of the industry cost curve, which is the primary reason for the stock's historical valuation discount. However, Harmony's high-grade South African assets like Mponeng operate with excellent free cash flow margins, 35%, demonstrating that grade can effectively offset the costs of depth. Strategic focus. The strategic focus also differs. Gold Fields is doubling down on its mechanized, long-life assets like South Deep in South Africa and its Gruyere project in Australia, while pursuing major acquisitions like Gold Road Resources. Sibanye-Stillwater has evolved into a multi-commodity producer, including platinum group metals, PGMs, and lithium, which provides natural hedging, but has also exposed the organization to the downturn in PGM prices. Harmony's strategy is more focused: remain a gold specialist while building a specific high-quality copper footprint. This clarity of strategy is favored by investors who want specific exposure to the gold-copper thematic without the volatility of the PGM markets.
The investment analysis of Harmony Gold reveals a company that is navigating a complex transition. Harmony Gold has leveraged a period of high gold prices to transform its balance sheet from net debt to a robust net cash position, providing the financial ammunition needed for international expansion. The acquisition of MAC Copper and the development of the Eva Copper project are the centerpieces of a strategy designed to diversify the company's commodity base and reduce its reliance on deep-level South African mining. From a valuation perspective, the company trades at a discount to its peers on a forward PE basis, less than 7.0x, and maintains a low PEG ratio, suggesting that the market has not fully appreciated the earnings potential of the restructured portfolio. The EV/EBITDA multiple of approximately 7.5x also indicates a relative discount to other major gold producers. While Harmony Gold's all-in sustaining costs are higher than the global average, the exceptional grades at Mponeng and the high margins at Hidden Valley provide a strong buffer for cash flow generation.
The net asset value of the company is supported by 36.8 million ounces of mineral reserves and a massive 135.5 million ounce mineral resource base. The 20-year life of mine extensions for the flagship South African assets provide long-term visibility, while the Australian copper assets add immediate and future growth. Investors in HMY are effectively buying into a high-grade gold producer with a free call option on significant future copper production. The primary risks remain tied to the South African operating environment, specifically electricity costs and evolving health and safety regulations. However, the company's decade-long track record of meeting guidance and its aggressive move into renewable energy suggest that these risks are being managed. As Harmony Gold continues to integrate its Australian acquisitions and move toward a final investment decision on Wafi-Golpu, the value over volume strategy is likely to continue driving record cash flows and supporting a competitive dividend yield.